Global stocks plunge as trade war escalates. At the start of the trading week, global stocks set record losses amid escalation in the US-China trade war. Asian shares fell to the lowest point in about 10 months on Monday as the Chinese yuan crashed, causing investors to hurriedly seek refuge in other assets such as the Japanese yen, gold, and various other bonds. As a reminder, late last week, Trump said he will impose a fresh 10% tariff on another $300 billion worth of Chinese goods in a sharp escalation of a trade war between the two countries. It came after the latest round of bilateral talks showed little sign of a breakthrough. The new tariffs, due to take effect on the 1st of September, effectively tax all Chinese imports to the U.S. China's Foreign Minister Wang Yi criticized the U.S. move. The Chinese authorities let the yuan decline below 7 versus the dollar on Monday. By the way, the People's Bank of China Governor Yi Yang said that the nation won't use exchange rates as a tool in the escalating trade dispute. Yet for President Trump, the latest decline in the yuan is called currency manipulation. Against this backdrop, Japan's Nikkei, for example, lost 2.3%, signaling the lowest point since early June. It's also the first 24-hour drop in a few months that has caused key players in the county to call for a special immediate meeting to figure out possible solutions. In Australia, shares lost 1.5%, while the Korea Composite Stock Price Index KOSPI in South Korea also rapidly hit its lowest point since December 2016, as it lost 2.1%. In Europe, stocks tumbled Monday as a rapid escalation of US-China trade tensions continues to spook investors. The Pan-European Stock 600 index fell 2.3%, which, taking into account Friday's losses, made for the biggest two-day drop in more than 3 years. On the data front, Spain's service sector growth eased in July, according to PMI data. Italian services activity grew by more than expected, but the numbers were not so promising for France and Germany. French services PMI figures slipped back from the previous peak in July, while German private sector activity came in at its weakest in more than 6 years. In the U.S., stocks also plunged after the Chinese government devalued the yuan to fall below its 7-to-1 ratio, with the U.S. dollar for the first time in a decade. The Dow finished down 2.9%, or 767 points, falling below 26,000 points for the first time since June. The benchmark S&P 500 closed nearly 3% lower, recording its worst day of the year. The index has declined for 6 days in a row for the first time since October. The Nasdaq Composite finished down 3.5%, its biggest decline since October 24, 2018. As for currencies, the dollar was under pressure as further escalation on the US-China trade war increased the odds of further rate cuts by the Federal Reserve. Against this backdrop, the Euro-USD rebounded above the $1.12 and the USD-JPY dipped below 106.00 and registered fresh lows at around 105.00 early on Tuesday. In commodities, oil prices edged down on Monday and refreshed lows around $59.24 today in Asia, from where the started to recover, but the bullish impetus is still too modest. The market is still very sensitive to signals from the trade front, with escalation in the conflict make traders resume the sell-off and send Brent below the $60 point once again. As such, futures remain under pressure as the trade war stoked concerns over the global economic growth and the future demand for crude. Iran's seizure of the Iraqi oil tanker had raised some concerns about the potential Middle East supply disruptions in the Gulf. However, it was not enough to offset the trade worries. Oil prices might get some respite later in the day as U.S. crude oil inventories are expected to be down for the 8th consecutive week. Now Brent needs to be firmly settled above $60 in order to extend the local recovery. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.